As interest rates keep rising, we want to take a closer look at the impact on regional banks. Huntington Bank shares, holding company for Huntington Bank, beating on the top and bottom line in its third quarter, but an 8% drop in profit year over year as its net interest income dropped. The stock trading a little lower today and down 30% this year. Not all that uncommon with some of the regional banks. Here for a Power Lunch exclusive is Steve Steinauer, Chairman, President, CEO of Huntington Bank Shares. Steve, why don't you explain the results today and talk us through how the bank is doing?
Sure. We had a very good third quarter. We're coming off a record year last year. Beat consensus by about 10%, 3 cents, total of 35 cents at the core. We had a little bit of one-time both revenue and expense in that. Otherwise, it would have been a 4-cent beat. So top line, bottom line beat, good, very good credit quality, grew deposits very, very nicely, continuing to grow deposits, I should say. So we feel really good about the quarter.
How is loan growth? Is it growing or static?
Well, loan growth this quarter was off a smidge. Part of that, the largest part of that, was commercial real estate. And we had about a $400 million reduction in that. And the second part was seasonal adjustment in our distribution finance. Now, that distribution finance, about $350 million, will come back on plus increments in the fourth quarter. We expect loan growth for the year to be about 5%, in line with what we originally said as we came into the year.
Net interest income increased about 2% from the prior quarter, but decreased from the year-ago quarter. Explain that to me.
Well, the difference is in our net interest margin. So the cost of funds, if you will, deposits and other funds, has increased, and that's compressed our net interest margin. Mm-hmm. It's an industry phenomenon. It's why bank stocks, in part, have traded off during the course of the year. For us, we're asset sensitive, which means as rates rise or stay high, that's actually good from our balance sheet perspective. That's helpful in terms of driving net interest income growth and expanded NIM in the future. And that's what we shared with the analysts. Our expectation is the fourth quarter plateaus, and then we're growing every quarter and throughout next year, both net interest income and net interest margin.
Steve, one of the things affecting a lot of banks and even brokerage firms is cash sorting, where your clients are, saying, hey, we want better yields. We don't want to keep it in money markets. Are you seeing that happen? And if so, how do you counteract that?
Well, there's a definite level of interest or yield on savings and investment that industries are looking for. But they're also, because rates are so high, they're also using their cash instead of additional borrowing. And many of these companies have had very good years, record years, back to back. And so they are cash rich, if you will. And so they have a variety of options. Use it in lieu of additional borrowing, invest it. And we help them there. We run about $25 billion of off-balance sheet liquidity in a liquidity portal we developed over the years. And we have about $35 billion of on-balance sheet commercial deposits. Deposits in total for us are about $140 billion.
Steve, can you just speak to the fact that the market is just stomping on regional banks and banks in general and said, in earnings season started out with a pretty decent tone to it. And it seemed like we moved through one day, we moved through the next. Everyone said, great, the banks are out of the way. It's clear sailing now. What happened? Is it rates? Just kind of give us your thoughts as a veteran banker at the equity prices that we're seeing the group in general trade at.
Well, I think the market has sort of sidelined in terms of financials generally at this stage. The performance has, as you said, generally been good. For ours, a 10% beat. Normally, that's an upmarket move. But interest rates are up, which means there's risk to the economy slowing down. And banks are cyclical. If there's a slowdown in the economy, provisions will be up, losses will be up, things like that. And the market can't quite calibrate around how far are rates going up. When will they peak? When will they come down? Will it be a soft landing or a recession? And until some of these uncertainties are addressed, you have that overhang. In addition, you also have a regulatory overhang around, for us, for our sector, Basel III capital. So the regional banks and larger have capital expectations increasing, at least from the regulators, as proposed. That has to go through a process yet. And higher capital means lower returns. You've heard from Jamie Dimon and others about what that means in terms of relative competitiveness. Wow. And those are all overhangs to the market.
It's a tough period, that's for sure. And that's even with almost an implicit backstop on all deposits. So it's really incredible. Steve, thanks for joining us today. Talk through things. We really appreciate it.